All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Looks like another little flat day in the market, right? No, not quite. Not quite. We talked about some of the things going on and some of the, some of the price action and activity, and it's one that we still don't have these reaction highs broken here today. But we've seen a little bit of rally since the market opened, a little drop, then pop. But nothing that I'd make too much out of. Here you can see the volumes coming in. They are very strong. These are some very heavy volumes to come in on the open at a level. Just some very, very aggressive volumes. And so there's a lot of shares trading hands. There is a lot of activity. You even compare this to yesterday morning, which was fairly decent volume. This morning is way bigger in terms of volume, almost to the double of yesterday. And, really kind of the volumes around the Fed Chair Powell are what we're seeing here. So very, very heavy volumes. I don't think there's a lot to make out of this morning's market that's different. I don't think you can look at most stocks and go, oh, well, you know what? They were bearish yesterday, so they're bullish today. Or even vice versa. This is a market where we are seeing the safe havens get taken out, get taken to the woodshed here. Consumer staples this week has just been absolutely plowed under. This safety area has just been shellacked here, for lack of a better word. Utilities to a lesser degree here this week, getting taken out, and then we still see China. We see the Dow setting new lows, small cap setting new lows, the S&P setting new lows, and then here's China. Still many percentages points off of their lows. And very interesting to see that. Not something we typically will see in normal corrections, but is something that we tend to see around some bottoms. And I don't think there's anything confirming or anything like that. But, you take a look at where emerging markets are and how they have performed this week relative to the S&P and other things. They're down, but nowhere to the same degree. And so that performance metric continues to be the only real bright sign for the bulls. And, that's not changing here today. In fact, it's even more evident here today than what it has been. We're seeing the banks, not getting really sold off. They're coming off their lows. You look at something like Bank of America, it's just been pretty much bought up since the close or since the open here this morning. We see some energy names with a little bit of strength, like a Halliburton, which was upgraded here this morning. I'll talk a little more about Halliburton today as well. But nothing too dramatic where you go, wow, okay, that's compelling and that's telling here overall. Micron, interesting snapback, after their earnings yesterday. You can see that, you can see kind of how this is ebbed and flowed here. But, I do think the highs from yesterday on Micron are a very interesting spot to watch from a trade standpoint, where if those get broken materially here, we could be talking about a little bit of short covering coming into play if that scenario occurs. But anyway, overall, VXX, I priced out some of the puts this morning. They're still not very interesting in terms of the risk reward. So I'm going to wait a little bit later in the day, like I mentioned this morning, just because we didn't get any kind of action this morning that I find to be telling, or okay, boom, this is something that's going to create a money flow here one way or the other. But did want to go out this morning and take a look at some of the steel stocks, combine that with autos, and combine that a little bit with some Halliburton, some energy names. And let's start off here. Let's start off taking a look at U.S. Steel, okay? And, we know it's been going down. Beginning hit hard, breaking below 20 here. And I'm going to come in and put on a correlation indicator here. and take a look at U.S. Steel and Halliburton and how they are correlated. Now, whenever we put on a correlation indicator, what we're looking at is, do these stocks move together, right? Do they tend to move together? And correlations that are positive up here at the 0.5, 0.75, 1 is a perfect correlation. But correlations that are positive mean that the stocks move in the same direction. Correlations that are negative mean they move in the opposite direction. Okay, so basically what do we see here? That over the course of this year, Halliburton and U.S. Steel have been more positively correlated than negatively correlated, which means they tend to kind of move together, but not always. It's a not an always type of a thing. But if we come back and put on a monthly chart and we look at the correlation, what do we notice? When it comes to Halliburton and U.S. Steel, what goes on? Well, they tend to move together. They tend to be positively correlated. And you say, well, U.S. Steel, Halliburton, they're both commodity stocks. Okay. All right. Halliburton's an oil service name. U.S. Steel is a steel name. What's going on here? Well, what happens when Halliburton's business goes up? Who do they go to? Who do they buy from? U.S. Steel, other steel manufacturers, right? For their products, and so you tend to see this positive correlation between the two. Now we can do this same thing, and instead of doing U.S. Steel and Halliburton, let's do U.S. Steel and General Motors. Now, General Motors hasn't been around as long, and let me get it corrected here. In terms of the stock itself, right? They went for another IPO right back here. But take a look at General Motors. General Motors has been more positively correlated with U.S. Steel than negatively correlated. If we come back and take a look at a weekly, we can kind of see this. And we kind of see that over the last while, they've been a little more positively correlated than negatively correlated. It's not the same as Halliburton and U.S. Steel, but it's not too far. It's not too far off. We're getting a little bit of correlation disruption right now as U.S. Steel continues to drop and General Motors is kind of hanging in there. But you think about General Motors, you think about auto manufacturers, right? Do they use as much steel as they used to? No, they don't. But they still use plenty of it. And so you look at kind of the end markets for steel. Now, whether we go to construction or oil services or automakers, and they tend to have some pretty hefty correlation there. In fact, we can come in and take U.S. Steel and put it with Caterpillar, right? What's the general correlation between the two? Well, yeah, there's going to be dips and stuff and negatively correlated periods when they have earnings and things like that. But generally, they're pretty positively correlated, Caterpillar and U.S. Steel. And you look at a monthly here between Cat and U.S. Steel. It is one of the stronger positive correlations that are out there. And it's not anything new. It's not anything surprising or revolutionary. I'm not saying anything that the market itself doesn't already know. But when we look at companies like the steel stocks and like U.S. Steel, there's a lot of commentary, there's a lot of opinion, there's a lot of data that we can look at and mine through and go through. But the reality is U.S. Steel does well when automakers, oil services, and industrials do well. And that has been a historic correlation that makes a lot of sense, and one that will continue to make a lot of sense. We can go through and comb through U.S. Steel's earnings reports, and we can look at their metrics. In fact, let's do it. We'll not comb through their earnings report, but let's go through and look at their metrics. Right? Here's U.S. Steel, and here's their revenue over the last while. Right? Here's the revenue. What's it look like? Well, it's been on the rise. It's been on the rise. Nowhere near 2014, 2015 levels. But, stock's been on the decline even though the revenue's been on the rise. Revenue estimates for the year, and they're not coming up here. I may have to restart this. There we go. Let's just restart it. But bottom line is the revenue estimates, they're nothing fantastic. Here we go. Fundamental chart. We'll go revenue. 10 years. Here we go. All right, so you can get a picture of the revenue or what it looks like. It's been on the rise. But nowhere near, 2011, 2012, 2013, 2014. In fact, when U.S. Steel stock price was back at these levels back here in 2013, sales were significantly higher than what they are right now. There's nothing in here to say, oh, man, this is fundamentally real cheap by looking at the revenues. Well, let's take a look at something like a PE ratio, right? Just a simple PE ratio. Price to earnings, it's at 5. Does that tell us much? No, not really. U.S. Steel PE ratio-wise just historically has no relevance, no basis. And most of the time when we get to a stock like that where the PE ratio doesn't mean anything, you go to the price to sales ratio. What's the price of their stock relative to their sales? If you look at U.S. Steel, is it cheap? Well, it's a lot cheaper than it's been. Is it at historical cheap levels? Nope. Nope, not at all. Its price to sales is not down where we have seen it get to in other sell-offs in the market, in the sector, and in the group, and in the stock itself in the past. Price to book value, it's below 1, but that's nothing new for U.S. Steel. Is it at a historical cheap level? No, it's not. So, the fundamentals, the metrics, the valuations for U.S. Steel have fallen and fallen sharply. It's no longer a price to book at 3, but it's still not in one of those historically cheap areas where you look and go, wow, this is really compelling because it's really cheap right here. Kind of in a little bit of no man's land. When we go and we look at Nucor, we go look at Reliance Steel, AK Steel. When we look at the group in the sector, we're going to see something very similar in terms of this is what the fundamentals look like. They're not terrible. They're a lot cheaper than what they've been, but they aren't at that historical cheap level where you look and you say, wow, okay, this is just almost too hard to pass up. We talked about U.S. Steel with Halliburton and other energy names back here in 2016 when they capitulated, when they got into historically cheap levels. We talked about why that's the bottom, why that is an area where there's going to be path of least resistance is up. We're not at that point yet. We could still get there. That could still happen, but it's not there just yet. And so what do you look for? I mean, what do you have to see, to say, hey, you know what, U.S. Steel, we're going to see a material turnaround from here out. Well, there's a couple things. One of the most important things is auto sales. I'm bringing up a website, Marklines, and this is a great site for getting just raw auto sales data. And I'm just coming in here to U.S. auto sales, right, and the U.S. flash report, and I know U.S. Steel has some international components, but let's just look at the U.S. And here we are for November. U.S. auto sales fell 0.8% in November. Now, there were more light trucks, that were sold, and, we saw a drop-off in passenger cars. In fact, passenger cars dropped off tremendously. But overall, year over year, sales decline. We can come down and we can look at October. There was a small bump up, but passenger cars fell year over year. Trucks, up year over year. But 0.1%. Are these moves, are these sales moves that are going to move the needle for U.S. Steel? Not at all. And we could come into September. There was a 6% contraction in auto sales here in the U.S. We can come back to August. 0.1% contraction in auto sales. All right, you probably get my drift. Here we are in July, 3.2% contraction in auto sales. And so for U.S. Steel to get that catalyst that it needs to drive on higher, it needs to see some year-over-year growth when it comes to auto sales, right? We're not talking about buying GM and buying Ford and all of that, which, they would benefit tremendously by seeing some growth in this. And some would argue that the comparables are set up very easy for next year for companies like Ford, Toyota, and General Motors. I'd be one of those to argue that it's going to be very easy for them to beat their numbers on a relative basis, provided we don't go into a monster recession or depression or whatever economic situation unfolds from here. But for U.S. Steel to ultimately bottom, for it to ultimately be able to say, hey, you know what, things are going to get better for U.S. Steel. We don't have to look at U.S. Steel's earnings. We don't have to care what people say about U.S. Steel. We can just look at these auto sales year over year. And as long as they are flat to down, the path of least resistance for U.S. Steel is flat to down. It's not higher. It's one of those where this tends to be a very nice leading indicator for the group. Caterpillar's earnings as well. When we hear Caterpillar and they start talking about ramping up production and increasing production, right? You think about who that benefits, and it's some of the steel makers. When you look at Halliburton earnings and they start talking about, okay, we're having a turnaround in demand, not oil demand, but in oil drilling demand, who does that benefit? That benefits U.S. Steel. So when it comes to really following and really kind of looking at the path of least resistance for U.S. Steel, to come in and just look at the U.S. Steel chart and to say, well, I'm bullish on U.S. Steel or I'm bearish on U.S. Steel or blah, blah, blah. Yeah, we could do that, right? We could do that. But to see a material turnaround, we're going to need some positives out of General Motors. We need some positives out of Caterpillar and some positives out of Halliburton for that to happen. Now, all three companies report earnings here in January and are going to give some outlooks for the year. Is that going to matter? Oh, you betcha. The outlooks on GM, Halliburton, and Caterpillar probably will matter more in terms of the ultimate direction of U.S. Steel than does the projection from U.S. Steel. And we will see that, coming here next month. And, in the meantime, is there any reason to step in and buy it, from an investor standpoint? Well, you can say, yeah, it's cheap and expect a turnaround, but, we don't have anything historical here where it can't get down to 16 or 15 or 14, right? We get down to those levels. Now we're talking about historically cheap. Now we're talking about, investment levels that may be a lot more interesting, and a lot more compelling there with it. But overall, it's not there. It is not there just yet. And whether we look at U.S. Steel, whether we look at Nucor, right, NUE, we're going to see about the same thing. Right, here's Nucor's price to book value, and it's come down tremendously. But is it at historic levels? Not even close, right? Their revenues, they've kind of been similar to U.S. Steel, right? But, pushing on up and climbing. But, worries about revenue going forward. Well, are definitely weighing on the stock. Its price to sales ratio has come down. It come down tremendously, but not to the 2015, 2016, 2012 levels that, put it and make it kind of historically cheap there. So, yes, they are significantly cheaper. They are significantly cheaper than what they've been, but they are nowhere near historical levels, and they are still in a situation where they need a positive catalyst. Now, here's the deal. When it comes to these stocks getting positive or negative catalyst, they tend to trend. They tend to last quite a while on these catalysts, right? Here's U.S. Steel. When it reversed in 2016, we started seeing some of the oil demand coming, or oil services demand coming back. We started seeing some of the auto sales numbers start to go up. We started seeing some of the Caterpillar news start to reverse and go more positive. This wasn't oh man, it's just if you miss the first or second day, you're toast. This was a major move for quite a while with some pretty sharp drops in the midst of it. Right, and U.S. Steel, this is not uncommon for them. This is not unusual for them. And in fact, if you want to, get some bearish exposure in this market and play for a recession or something of that nature where things are going to get worse before they get better, U.S. Steel still has a long way that it could drop and that it could fall to get to those historical type of levels. So bottom line, we don't see the positives out of the group yet. We don't see the fundamental positives coming in. They are still on the bearish side when it comes to these names, and they're not historically cheap. So path of least resistance still is lower. Is there a chance of a bounce at any time? Yes. But to create a more major turnaround, to create an end to this bearish drop, it needs one of two things. It needs a really positive catalyst that comes from a macroeconomic standpoint. Let's say China does something fiscally to change things. Let's say the U.S., does something fiscally, which, none of those are being telegraphed or on the radar right now. So, but, if something like that were to happen, that would be a kind of a game changer for them. Or we start to see earnings outlooks from Caterpillar, Halliburton, and GM essentially start to get more positive or growing positive here for 2019. And I do think that when it comes to stocks like U.S. Steel, the bottom could be in. But a stock like U.S. Steel rarely hits a bottom and just bounces up. Its more major bottoms take time. They develop over a period of 6 to 8 weeks. And I kind of expect that that's what it will take here with U.S. Steel for some sort of, and the other steel manufacturers for some sort of, bottom to come into play. All right. I do think they can be sold on rallies overall, and still traded back down to levels that they see, meaning if U.S. Steel were to bounce up to 21 or 22 in the coming weeks, it probably comes back and revisits 19 and 20, and can be sold given what's happened, barring one of those catalyst changes coming into play in the meantime. All right. Thanks for hopping on. Have yourselves a great one. We'll talk to you later. Take care.